All right, let's dive right into this explainer. Even if you follow the financial markets closely every single day, it absolutely pays to step back and revisit first principles every now and then. Today, we're stripping the foreign exchange market down to its bare bones mechanics. We're going to get a crystal clear look at the foundational structure of this market, why it operates as the largest financial engine in the entire world, and exactly why massive global institutions and everyday traders are in there mixing it up every single day.
So think about this for a second. How do people actually capture profit just by buying and selling currencies like the US dollar, the euro, or the British pound? We've all seen the flashy headlines, right? Or heard people casually drop that they trade Forex. But that usually leaves a lot of us wondering what the actual practical execution of that looks like. Today, we're cutting through the noise of complex indicators to focus squarely on the underlying mechanics of how these folks actually aim to turn a profit.
At its absolute core, Forex is just short for foreign exchange. If you strip away the flashing terminal screens, the algorithmic trading bots, and the wild jargon, what are you left with? Well, it boils down to one simple, profound thing. It is literally just a global marketplace built entirely for the process of swapping one nation's currency for another. You're trading the money used in one economy for the money used in a different economy. It's the foundational exchange that makes our entire modern, interconnected world possible. To really ground this, just imagine you're standing in an international airport. Let's say you're traveling from Nigeria to the US. Before you even get on that plane, or maybe right after you land, you've got to swap your Naira for US dollars, right? Because, well, you need dollars to buy anything in America. Right then and there, at that little airport kiosk, boom, you've just participated in a Forex transaction. You're already an active part of the foreign exchange market, whether you realized it at the time or not.
Now here's where it gets wild, the sheer scale. Think about that exact same airport transaction we just talked about, but multiply it. Millions of times, every single second, all over the planet. This compounding activity creates the world's largest financial market. We are talking about trillions, yes, trillions with a T, of dollars exchanging hands globally every single day. Because so many massive players are involved, this market is incredibly liquid, meaning buyers and sellers are practically always available at a moment's notice.
You might be asking yourself, why does a market this massive even need to exist in the first place? Well, it exists out of absolute necessity. It's basically the plumbing of the global economy. Countries are constantly trading goods. You've got massive multinational companies constantly importing and exporting materials across borders. Everyday tourists are traveling, and sovereign governments are buying resources. Every single one of these activities requires different currencies to get the deal done. And that fundamental need to exchange money? That's exactly why this market pulses day in and day out.
Okay, so here's the crucial takeaway. Trading in this massive arena relies on one super simple, foundational idea. You want to buy a currency when you genuinely believe its underlying value is going to rise, and you want to sell it when you think its value is going to fall. That's the whole shebang. Whether you're a retail trader working from your couch or some hotshot hedge fund manager on Wall Street, the goal is exactly the same: forecasting and profiting from the constant, minute-by-minute changes in those exchange rates.
Which brings us to a mechanic you absolutely have to understand. In Forex, currencies are forever linked in pairs. Always. You'll see things like Euro/USD, GBP/USD, or even XAU/USD, which tracks gold against the dollar. That first currency listed, that's your base currency. The second one is your quote currency. What this means in plain English is that when you buy a pair, you are simultaneously buying the base currency and selling the quote currency. It's like a perpetual financial teeter-totter of value.
Let's look at a quick real-world scenario to see how this flows. Say Euro/USD is currently trading at 1.200. That just means 1 euro gets you $1.20. Step 1. Based on your analysis, you think the euro is going to flex and get stronger relative to the dollar, so you hit buy. Step 2. Time passes, the market moves, and sure enough, the price bumps up to 1.2050. Step 3. You close the trade right there. Since the value went up just like you predicted, you just captured a profit. If it had tanked instead, you'd eat a loss. That 1-2-3 sequence is the fundamental engine driving all Forex trading.
Now think about the traditional stock market. The bell rings in the afternoon, trading stops, and your capital is locked up until the next morning. Not Forex. A huge structural advantage here is the accessibility. This market operates 24 hours a day, 5 days a week. It literally never sleeps during the traditional work week. This continuous operation gives you immense flexibility, letting you react to massive global news the very second it breaks, no matter what time it says on the clock. How is a 24-hour cycle even possible?
Well, it's basically a global tag team. As one major financial hub closes up for the night, another one is immediately flipping the open sign across the world. It's a continuous relay race. It kicks off in Sydney, passes the baton over to Tokyo, moves on to London, and finally wraps up the day crossing the Atlantic into New York. This global rotation is exactly what keeps the liquidity flowing constantly and lets traders participate from almost anywhere.
So who's actually slinging these trillions of dollars through the system every day? It's a really diverse ecosystem. You've got major commercial banks completely dominating the space. They drive about 45% of the total volume. Right behind them are massive multinational corporations, representing roughly a quarter of the market, and they're mostly just trying to hedge their international business risk. Throw in central banks managing national reserves, heavily capitalized hedge funds looking for yield, and finally, everyday retail traders. Everyone's in the same pool, but with entirely different motives.
Which naturally leads to the question, can retail traders like us actually participate alongside these massive institutions? Because of modern technology, the barrier to entry has essentially vanished. Yes, absolutely. Today, if you've got a smartphone, a reliable internet connection, and a registered brokerage account, you can access institutional-grade platforms and start navigating this global market right from your living room.
But hold your horses. Before you rush out to test the waters, we really need to highlight a crucial insight from our sources. Learning is much more important than simply opening an account. Listen, having market access is not the same thing as having an edge. Successful traders do not rely on guesswork. They invest a heavy amount of time into proper education, strict risk management protocols, and psychological discipline. They practice extensively in simulated environments long before they even think about risking real money.
And while we're at it, let's crush a few dangerous myths about this industry. Forex is absolutely not a form of gambling. Actually, scratch that. It can be if you treat it like a casino, but fundamentally it shouldn't be. It is not a get-rich-quick scheme designed to teleport you to a tropical beach overnight, and it is definitely, without a doubt, not easy money. Believing those myths is exactly how newer participants get trapped and wiped out.
The stark reality? Surviving and thriving in this trillion-dollar arena takes immense patience, highly specialized education, and relentless practice. You have to treat trading with the exact same respect, dedication, and long-term perspective you'd apply to mastering any true professional skill, like engineering or medicine. It's a continuous, never-ending journey of refining your strategy, managing your risk, and ultimately mastering your own mind. All right, let's bring it all home. Forex is this continuous, globally operating market driven by international commerce and the strategic hunt for profit. We now clearly understand the foundational mechanics of how it all works on a functional level. But that leaves us hanging with one really fascinating question. What are the real-world, macroeconomic factors that actually cause these currency prices to move in the first place? Like, what fundamentally forces the euro to suddenly surge in strength against the dollar? Well, that is exactly what we're going to unpack in our next explainer.